European energy traders are exhausted. Taco fatigue is setting in, and the TTF front month, the NBP front month, and the TTF and NBP front season contracts are only gradually drifting with no strong conviction either way. European carbon contracts are set up for a significant bounce, but we are still waiting for the trigger level to be hit, and the German power markets still have a little bit of room to decline. My name is Marcello Kolax. I'm the managing director here at Clever Markets. So if you are a speculative trading desk and you are fed up with all this uncertainty and high volatility, or if you are a physical trader looking to lock in some volume at the best possible price, then your best first step is downloading our quick start guide on building your own methodology before you start working with us. Link is in the description. Of course, everything you see here is not trading advice. It is just my humble opinions on the market and also not an invitation to trading. So look at this. This is what we have been dealing with week on week. For 6 or 7 weeks in a row, we had strong bullish dominance on the TTF sentiment benchmark, where we've been asking you where you think the TTF is going to go for the next week. And you can see 2 weeks ago, we were 67% bullish. And this week, it is just 50%. So this is a very drastic change week on week. Look at this. This is our Clever Markets dashboard, and you can see for like 1, 2, 3, 4, 5, 6 straight weeks we had real bullish dominance. The last time we reached a similar level with around like 50% was in early March, and this is completely understandable. The market is exhausted. The Strait of Hormuz is open, it's closed, the war has been won. There was no war in the first place. Iranians want to negotiate. Iran has never been contacted. So right now, European energy traders are trying to decipher what the public meltdown of a senile man could mean for our energy markets. Well, and that man happens to be the most powerful man in the world. But after weeks and weeks of back and forth, everyone seems to be exhausted and taking every bullish or bearish announcement with a grain of salt. So that's why the markets haven't really been moving much. So let's have a look at the TTF front month first. So here you can see last week we have already anticipated that the bull trend is over. We are probably most likely going to drift a little bit downwards, and exactly that is happening. So you can see here over the past couple of days, we then also saw that the 8 exponential moving average crossed below the 12 exponential moving average, which in itself is a strongly bearish signal. Because if both of them are already pointing lower, that is called a death cross. So the bears are simply accelerating. Now, what is the momentum doing? Well, the momentum is also on the decline. So here we are looking at the MACD, the moving average convergence divergence. And if we start getting a cross below the zero level, then the bearish momentum is fully in charge. Of course, we're also always keeping an eye on the stochastic. So this here is my oscillator of choice because we are just waiting for a bullish signal. And the bullish signal would be given above the 20 level when we start moving above oversold territory. Hasn't happened yet. So please be careful. Just because we move into the extreme level, into oversold territory, doesn't mean the market is ready for a bounce. Absolutely not. This is probably by far the most misunderstood tool out there. So moving into the extreme level simply means we are making new lows. The bullish signal would be given if we are no longer making new lows, as shown with a move above 20. So for now, we just monitor that. There's no bearish signal right away. So this was the classic technical analysis. Now let's have a look at our proprietary indicators. And honestly, this is like the first thing that most of our clients are looking at in the morning, and that's what I suggest as well. Start with our regime index. So here we are seeing, is the market trending or not trending? So you can see right now it is a gray dot. That means the market is not trending. So that also means that we are not looking for any big trend following trade setups here. We are very acutely aware that the moves are going to be muted, they're going to be small. So that means we are not making trading decisions on the daily chart, waiting for a big swing trading opportunity. Much rather, we are active on the hourly chart and making use of the smaller swings there. So, first things first, the market is sideways. Neither the up legs nor the down legs are expected to be long right now. Then we start looking at the trend indicator, which is our proprietary trend momentum tool. So let's have a look here. You can see, zooming in, we have topped out a couple of weeks ago on the 19th of March with a state of 13, right? So this was expected, and we did make this very good call. Since then, the up leg has weakened, and then we have now transitioned into a very weak bear trend. This is a very weak bear trend. We are not fully trending yet, and we are still very susceptible to any sort of taco news that could see the market spike. So -5, we are not in the clear yet. Just to give you a better understanding, the bullishness and the bearishness, as indicated with our proprietary trend momentum tool, can go from -20, strongly bearish, to +20, strongly bullish. Right now we are at 5, which is the territory where there is no strong trend. And you can see this. So -5, it could revert very, very quickly. In case you're wondering what this is, don't worry about it, but just look at this beautiful bell curve that is completely normal in a sideways market, right? Where the market is swinging from a state of -17. Once we hit that, we swing to a state of +13, right? So these are the extreme ends. But for the TTF specifically, we only tend to go until the -11. Right now we're at -5, so there is still a little bit of room to decline before we start swinging the other way and then probably top out in the like 8 or 9 area. So there is still a weak chance of the bears to continue. And look at this. This is our box plot of expected forward returns in the next 8 days. So just in case you're wondering what this is, if we are above the green line, that means we're expecting positive returns. If we are below the green line, that means we're expecting negative returns. And these box plots here, or these shapes, they are simply showing us how great the chances are. If we have like a really tiny body, and these like tiny wicks, then there's a very high likelihood of this scenario playing out. If it's like really broad and wide, then it's anyone's guess and it's more or less a coin toss because the positive chances and the negative chances are evenly distributed. And you can see down here we have the same numbers from -20 to +20. We said right now we are at -5, and you can see we are in the middle of the middle with a really tiny body. So there is no clear preference right now from our proprietary indicators, which is why this here is so fragile. However, we still believe that ultimately we can move below the 42.5 early this week and then make it towards the 200-day exponential moving average, which is in the 38 region roundabout. And here the market will have to make a decision. And we'll make this best on the hourly chart. If we start seeing a bullish setup, so meaning like bullish reversal candles, or seeing that the flow of lower lows and lower highs is getting shallower, then there's a good chance for the market to bounce. And because we are still neutral, our preference is a bounce. The market isn't going anywhere. So this up leg here doesn't mean bullishness, it just means continued indecision. If, however, we start pushing below the 38, then the bears might be fully in charge and the down leg might continue. And if you are looking at our tools, then you might see this here to move further from a -5 to -6, 7, 8, 9, 10, 11. And then we always at every day cross-reference it. Okay, how far has the price moved? And if we start seeing a high reversal area and it is combined with a high reversal setup on the chart, which means a support level, then the chances of a bounce are greater. But hey, if we are down here and we are still just at, I don't know, -6, then we know that the bears still have some room left in the tank. Now, let's have a look at the hourly chart because this is where we make the tactical decisions. So here you can see we have pushed outside of this rectangle that has been restricting price moves since early March, and we have now added a descending channel. And the market is very reliably moving within that. So channels in themselves, they are super interesting because they're offering us support levels. So for speculative traders, this might be an interesting buying opportunity countering the existing downtrend. But of course, for speculative traders, we are more interested in the market topping out and then looking for the decline because the down legs and the downtrend, of course, tend to be a little bit longer. For physical players, channels are also super interesting because we we are trying to average in at the best possible price. So we are trying to buy in these troughs and we are trying to avoid buying in these peaks here. And these channels are giving us very precise levels when to do that. So what do we expect for early Monday? Well, we are still within the channels. We are expecting the market to decline further. We see that the 8 and 12 exponential moving averages are still bearish. All right, fair enough. But we see that support has held once, twice, three times at 42.5. We really want to see a break below that before entering any shorts this Monday. Because look at this, the MACD, the momentum tool, has not been making lower troughs or higher highs for quite some time while the market is still moving lower. This is a symptom of the market overall still being super indecisive, tiny up legs and down legs. So be aware of that. Now is not the time to enter any big positions. Keep it small. Also, on the hourly chart, we are seeing that we ended last week with a bullish stochastic signal. So overall, there is a chance, a tiny chance for the market to open a little bit stronger because this signal happened at this important 42.5%. But once again, neither the bulls nor the bears are in charge. So overall, even if we get a bounce and maybe that bounce goes towards the 45.5, right, which is this old rectangle support that is now turning into resistance, even with that, we still expect the market to continue drifting marginally lower. So that is the main direction overall, even if we open just a tiny bit stronger. And remember, 50% of the market are still bullish. So if we start pushing below 42.5, half of the market is going to be wrong. So they might be looking to reposition themselves in alignment with the prevailing down leg. So this could fuel the initial down leg if it happens. But once again, we are working with very clear trigger levels, 42.5 for the bears and the bulls. They would really have to push for it. Look at this. First, they would have to go above the 45.5, then the 46.7, which is this resistance here. And even beyond that, they would probably have to make it above this channel resistance. So there's a lot more resistance in place than there is support, which makes it overall a little bit more likely for the market to continue lower. Now let's have a look at the German power markets. And I want to go through the more structured way and look at our regime index first. So on the dashboard, I'm just going to the daily chart and go to the regime index, and I have a look at what the market is doing. So you can see we have had this like really hot market that was expected to come off, which it of course did. And right now you can see we have been in gray territory for some time, which means the market is overall neutral. Then, even within a neutral market, we still get our up legs and down legs. So let's see how strong they are. So right now we see that we are at a state of -5. Remember, -5 is a weak bear trend. So there is a lot of indecision. I wouldn't even call it a trend. The market is just indecisively swinging. So you can see -5. So there is still a little bit of room for the market to decline probably until like -10, which is where you see this big drop off, right? So probably can make it until -10 before swinging the other way, swinging towards a bounce. So for that, we are now looking at the chart. What does that mean in practice? So here, all of this is perfectly reflected. Yes, we have topped out and we are coming off, but there is no trend to speak of right now. So we do still see that the market has some room to decline, maybe towards the 200-day exponential moving average near 85, which is also a psychologically important level. But we don't really think that the market will make it much further because we are still in non-trending territory. So we are expecting mean reversion to remain in place. Now let's have a look at the classic TA because that looks a lot more bearish. We do get a bearish crossover or a death cross on the 8 and 12 exponential moving average. We do see that the MACD is pointing lower, but we didn't get a bullish crossover below zero yet. And the stochastic is also not giving us any bullish signals whatsoever. So here, once again, the classic TA is showing us that a little bit more room for downside is in the cards, which is in alignment with the marginally bearish indication on our proprietary algos. So, but how do we trade this? Well, not on the daily chart, because there we would just be guessing what the color of the next candle would be. Ideally, we want to be dealing with swings. And on the German Power Frontier chart, hourly chart, we have this falling wedge that has been holding very nicely. And falling wedges are showing us that the down legs are getting shorter and shorter, which makes a break higher more likely eventually. So you can see here, we ended last week at this important support level that held 3 times, once, twice, 3 times. We bounced a little bit with this bullish candle pattern setup. We did get a bullish stochastic signal here. So we might be getting a marginally stronger open. But overall, we still believe that a move below 88.36 could very easily move towards the 87.06 before we start looking for buying opportunities again. And can you see the 87 is this level here? Eventually, we still think that we could make it lower towards 85, right? So after this bounce, on the hourly chart, there even is a chance for us to just continue lower overall within the descending wedge. So monitor the hourly chart with the swings. As long as we remain within the falling wedge, the downtrend will remain active and could strengthen a little bit on the daily chart towards 85, provided that our algos are still in alignment with that overall. Now, the last market we look at today is the EUAs. It is a little bit more visible on the hourly chart, but here on the daily chart, we see that a head and shoulders, an inverted head and shoulders pattern is shaping up. So after an extensive down leg, we see that the bears are still trying, volume is declining, and the bears are simply exhausted. We did get this bullish engulfing candle pattern, which then launched this up leg. And since then, the bears haven't really made it any further. We are just here. So right now, the right shoulder is still forming, and we do have a neckline near 74.5. So if we get like a convincing close above it, then we would see a more significant bullish setup. But we are still quite skeptical because we have the 200-day exponential moving average resistance near 78, 79, just right here. 77.3, that is. So we don't think for now that the bulls have a great chance despite this bullish setup. But yes, we look at this. We are aware that we just got a bullish crossover on the MACD, and we do see that the stochastic is pushing higher. Remember, moving into overbought territory is not the signal. And we are seeing that the faster moving average is pushing higher as well. So we are acutely aware of that. And on the hourly chart as well, here the head and shoulders pattern is a little bit more clear, but we can see already how unable the bulls are to actually push above this really important level because everyone is looking at it. So if we push above, what is this, 75 or 74.5, if we push above this resistance area, then the bulls will be given a fair chance. Because this thing has been moving sideways for so long, we can't really use the MACD. That is kind of useless in a sideways market. We do get this bearish stochastic signal, right, that we got on the 10th of April. We are now pushing lower, but it is just this tiny down leg here. So let's have a look at the algos. Maybe they give us a little bit more clarity. So we go to the EUAs. And here, first of all, we go to the daily chart. By the way, this is all for the daily chart. This is not for the hourly or weekly chart. And here we are seeing that, ooh, it is a little bit red. So red doesn't mean bearish. Red means hot. The market is hot, slowly trending a little bit. Okay, so we got some trend going on. What kind of trend? Is it a bullish trend? Is it a bearish trend? So let's have a look at our trend momentum tool. Still pretty weak. Look at this. We moved from a state of -5. Remember, this is high uncertainty. The down leg is less than confirmed. Everything is up in the air. Then we moved towards a state of +2, also meaningless, and then to a state of -2. So we are still not trending. The bulls are not convinced. The bears are not convinced. So can you see this? This looks very different to the bell curve. Remember the other markets, it all was like more like a bell curve because they're still in a mean reverting sideways mode. The EUAs, however, have entered a trending state, but you can see very low bars means that this state is rarely being hit. So the EUAs are still super indecisive. And the interesting thing is, low bars means the state is rarely hit. High bars mean the state is more often hit. So what we usually see is when we have like a budding bearish or bullish trend, we usually jump. So that means we have like a strong breakout most of the time, both towards the bullish and the bearish side. So right now it is recommended to maybe stay on the sidelines overall and see this whole thing play out. Some traders that have an inherent bullish bias might use this whole period to accumulate because they think the market will continue higher. I mean, that is also our preferred scenario, right? But if we start pushing below 70.4, we know that this bullish attempt will be delayed. That is all for today from us here at Clever Markets. If you want to get started with technical analysis, but you don't know where to look first, then do download our free quick start guide on building your own methodology. This is exercise for you to know what are the elements that I need to really embed systematic trading. And if we are a good fit, we might get in touch with you to talk details. Everyone, have a good start into the week. See you around and bye bye.